Good morning, everyone. This is Ben Ryan, and welcome to the Hedgeye Morning Macro Call for Friday, November 7th, 2014. Before I hand the call over to Keith, I'll touch on our day-over-day changes in asset allocation. We decreased our cash position to 70% from 72% yesterday. Fixed income exposure was increased to 29% from 27%. Currency exposure held flat at 3%, and still no allocation to commodities, international equities, or U.S. equities. With that, take it away, Keith.
Thanks, Ben, and good morning. Before I get into the top three things this morning, I'll give you the top three things on this jobs report. Number one, it was bad. Number two, there's no wage growth in this country. And number three, it was bad. So buy bonds. Top three things in my notebook this morning other than that. And again, the rest of the world does not cease to exist, although the U.S. seems to be dislocating from deflationary risks that are worldwide. So we'll go through that. The top three things in my notebook this morning are indeed the Japanese yen, Russia, and the 10-year bond yield here in the USA. So first on the Japanese yen, don't forget that most of what bailed people out in U.S. stocks from the fetal position that was October the 13th, don't forget that. Again, 150 points, 160 points lower in the S&P 500 was indeed two central planners coming out with emotional reactions to it all. One was Bullard and one was the Japanese. Now, the Japanese experiment is fantastic to watch. So again, they've had 3 up days in the last 4, but where do we go from here? More importantly, look at the risk range in both the Japanese yen, which is wacky wide. And a wacky wide risk range is a leading indicator for what? Volatility. So there's a wacky wide risk range in the Japanese yen of 111 to 117, risk range being the immediate term. And then in the Nikkei, get this, the risk range is now 14,602 to 17,378. Now you can drive a wacky tobacco Mack truck through that risk range. And that means that you could go down, literally, you could go down 15% in a day in Japan if people decide to not suspend disbelief. So again, this experiment in central planning is going the wrong way. And if you can't see that, look at point number 2 this morning, which is indeed Russia. Now Russia, just newsflash, is crashing. It's the top 6 economy in the world, notwithstanding that other places are also crashing, like Brazil, which is number 7 in the world. And Japan, by the way, is in the top 7 too. So with all these things crashing, of course, nothing could possibly go wrong from the all-time highs in the S&P 500. But indeed, Russia is linked to the deflation in oil. So again, follow the bouncing ball. The Japanese and the Europeans burn their currency. The US dollar goes up. Everyone and their brother says that's good for the US economy, when in reality it's deflation. Stupid. Again, deflation. The Russian deflation. Not good. We reiterate the short call on Russia. And then finally, the 10-year bond yield. How many times this year, I guess we're going into the 10th month this year, that you could buy bonds, the long bond being on a pullback? Now, a friendly reminder that the return, the rate of return on the long bond, which is TLT, if you want to look at the 20-year version of that, is much greater than the Russell 2000. In fact, it's like 1,900 basis points better than the Russell 2000. It's even better than the almighty S&P 500. So again, on bad jobs data, on global growth slowing data, what do? You buy the long bond. Okay? That's it. Simple, simple. Even a mucker with an M can do it. Those are your top 3 things. Okay, so just getting into the grind here this morning. We're doing this morning show. Again, this is the process. This is not new. We're just showing it to you in this really friendly way. And it is my birthday. Again, it's the firm's birthday, my son's birthday, so it's a good day. Todd Jordan's son's birthday too. Derek, happy birthday to you. Looking at today's upside downside in the S&P 500, there is a wacky amount of asymmetry in as much as there is in the Nikkei. So again, what we call the immediate term risk range, so again, immediate term duration, 3 weeks or less, is 1967 on the S&P 500 to 2046. Now 2046, if you go up there and knock on the door, I mean, you can have fun up there, but I'm not going to tell you to buy it. I've never told you to buy a bubble high, and a bubble high we would define as the all-time high price in anything. It could be tulips. It can be gold in the year 2011. It can be the S&P 500 right now. I do not tell you to buy the bubble at the all-time high. All-time is indeed a long time, and if you have to incur a cost basis of the all-time high, that might wear on you for a long period of time. Looking at the risk range in the Russell 2000, no support to 1121, and then there's no support below that to 10,000, or at least 1005. Let's just use that number. There's no 10,000 in the Russell 2000. Looking at the VIX risk range there is 13 to 28. 13 to 28, that's the intermediate term. Again, the VIX could, in other words, in the intermediate term, the next 3 months or more, go back to right where it was in October, which is 28. So again, looking at that for what it is. Volume yesterday, an interesting thing. And again, our process is not the moving monkey process where you pull up a chart and you say, okay, look, it's above the 50-day and the 10-day and everything's fine. Again, what they use is price when they're telling you that. It's above a simple one-factor model moving monkey. Now, what we do is get really, really mathematical on this, and we use 3 factors. Again, we use volatility, volume, and price. Now, volume yesterday at the all-time high was down 7% versus the 1-month average. Now, again, I'm talking about total U.S. equity market volume, including dark pool volume. So again, that is what it is. Decelerating volume on the up move. This is exactly what we would have told you on this call and did call you on September the 19th. Through the end of September, and again, you may have listened to it then, and I hope you did, because you wouldn't have had to be in the fetal position by October the 13th. So again, decelerating volume on the up move is an explicitly negative signal, while implied volatility is rising. So again, that's exactly what's going on here. That is indeed the truth. Now, looking at sectors, if you just stay with the Hedgeye playbook, we like healthcare, we like consumer staples. We'll go with utilities on certain given days if, in fact, they're oversold. We do not like, and I repeat, we do not like energy, basic materials, consumer. These are the sectors that are either early cycle, so again, in other words, the early cycle is slowing, which you can see in the unemployment report today, and or deflation. So when you have the cycle slowing economically from a 65-month rally, don't forget that we've had 65 consecutive months of U.S. economic expansion, and now we're about to slow. Now, at the moment that we haven't yet slowed, obviously, to every single macroeconomist in the world, you're going to slow. That's the point. That's why we do macro from a cyclical investor's perspective as opposed to a pro-cyclical investor's perspective. Pro-cyclical means that when the late cycle data is good, these guys are jubilant, and when the late cycle data is bad, they're in the fetal position. So again, don't do that. Invest like a cyclical investor. The S&P 500, the stock market, the bond market, they are indeed cyclical. So again, keep that in the back of your mind. Now, just looking at Asia, just to circle the horses here, while Japan's doing what it's doing, there's something not so funny that happened on the way to the Asian Forum, which is indeed that all of Asian stock markets went down. Down. Hang Seng. I know that Kernan wasn't talking about this morning, but the Hang Seng's down for 4 consecutive days amidst euphoria that this time in the U.S. it's different. Just newsflash, it's not. So again, looking at Asia, equities have been very weak, actually, never mind in Asia, in emerging markets throughout this week. Brazil was down another 2% yesterday, by the way. Now, just jumping ahead to Europe. Now, what do you do in Europe if this latest central plan, which was yesterday, Mr. Draghi is telling you that he will walk on the water? He will provide whatever for the camels. I mean, this guy is so full of it. I mean, if it wasn't another time, you would say that he was a socialist or fascist. This guy is crazy. Again, I think he's nuts. I think that the Germans think he's nuts, and that's going to change going forward in terms of how the Germans say that they're tied to this guy. So again, look at the reaction in European equities. It's called lower highs. It's called deflation. So again, when we contextualize what's going on in Europe, we look at the DAX, the CAC, the MIB index, etc., and we look at the trend. The trend is broken. The trend is your friend as a short seller. We would reiterate Europe slowing this morning. Now, commodities, commodities, you know, they're deflationary. I don't know why people are looking at the signal that is gold and oil and copper and iron ore and saying that that's good. I mean, like, seriously, let's get a grip on this. Now, last year we would have told you that falling commodity prices with strong dollar and rates rising is good. Don't forget the last part of that. Rates rising is good. When rates are falling and commodities are falling, that means that demand or forward growth expectations are falling. So again, only can say this so many different ways. And again, we said it into the end of September. I'll say it at the beginning of November. I'll say it in the middle of November. And God forbid, I'll say it at the end of November too. So again, this is called economic gravity. The cycle is indeed slowing in commodity terms. Now, finally, 10-year bond yield, just looking at the risk range. You know, Geronimo, if you're short bonds, I saw somebody tweeting about, look at how good the 10-year bond yield looks this morning. It's at 2.40%. I mean, McFly, it's crashing for the year to date. So again, look at the 10-year bond yield. There's immediate term downside to 2.21, and then there's no real support to 1.9%. So again, if you're long the TLT, the EDV, yeah, you and me, anything, get in bed with me on the long side of the long bond. That's where we're going. We're going lower. 10-year bond yield's going lower. There's a magnificent way to express our bearishness in global growth on the long side. You know, there's always a bull market somewhere. And it is indeed in bonds. So let's stay with that on top of everything else. I think it's probably a good spot to, actually, I got to, before we take some questions, today's, I guess, central planning news of the day, away from the jobs report, I couldn't make this up if I tried. Janet Yellen is speaking at La Banque de France at a Parisian central planning conference. This is where we are. She's in France at a symposium talking about what she can do. I mean, this won't sound crazy until these things are breaking down. That's all I have to say about that. I think it's a good spot to take some questions.
Sure, Keith.
Do you want to go get some Parisian breakfast and talk with Jeannette about le central plan?
Maybe. It sounds like quite a trade show over there.
Yeah, it sounds like a fantastic event.
Yeah. So a couple questions here on the dollar. I'll just go ahead and combine them. If we are in a deflationary environment with the dollar going up, wouldn't you expect stocks to go down? And then at what point does a strong dollar get you more excited about U.S. growth?
Well, just newsflash, stocks have gone down very, very hard most recently on the dollar going up. So the higher the dollar goes with rates falling, the most likely they are to fall again. The longer we suspend disbelief, and again, I was in Boston, San Francisco, Los Angeles, and I mean sophisticated investors who are, by the way, having a tough time this year. It's not easy out there. I understand that, unless you're long bonds and short the Russell. But again, when people are long only of equities, that's a different story. And what they will basically say to me, the meeting goes something like this. Why can't the market not just go up all the time? Like, why isn't it different this time? It's all about the upside. Infrequently, if never, do people talk about the crash components that are developing in the stock market. So again, there's an explicit signal that was issued to people who are buying stocks on the pullback in October of 2008. And again, you got a big pullback in October of 2014 as well. So again, I'd remind you of this. The dollar's going up and interest rates are going down. That was an explicit signal that global growth was setting up to surprise on the downside. It's a deflationary signal. It's very different than dollar up, rates up. Or this year in India, rupee up, rates up in India. That was a growth signal. In the UK, they had the same thing. Again, last year, that was our bull call on U.S. equities. Rates up, currency up is a growth signal. Currency up, rates down globally, and that currency being the dollar is deflation, and very few people understand that. We have not had a sustained period of deflation in this country since 1927 to 1933. This is why the central planners are right petrified of it, and they should be.
Next question here on S&P volatility. So volatility is cheap right now, you're saying? Should we start buying S&P puts?
Yes, absolutely. I mean, why wouldn't you buy? If you're the raging bull who thinks that the market's never going down and you still don't buy puts, you're crazy too. I mean, look, it's crazy as crazy does until you get it to a spot where people are in the fetal position. Again, I don't know why people are so confused as to why 3 weeks ago is much different than today. Today, by the way, remember the last jobs report? The last jobs report was allegedly good. The big O put up some big G. Remember that? There's some government hires in there right before the midterms that, on rate of change terms, the last labor report was pretty good. Well, this labor report is pretty bad. This labor report is basically telling you that if you didn't sell them 3 weeks ago, or 4 weeks ago, or 6 weeks ago, or in the Russell 2000, by the way, 4 months ago when it topped, you have a wonderful selling opportunity here that is based on the most obvious indicator slowing, which is employment. This is a late cycle indicator. It just slowed. So what do you do with that? Do you buy? I mean, you got to come up with some really good storytelling if at this point the unemployment rate goes from 5.8% to 6.8% in the next 6 months. Let's just say that happens. Let's just say that happens for argument's sake because nobody thinks it can happen. Therefore, the probability is rising that it could happen. What do you do in that environment? Do you just keep buying the damn dip? Come on.
Good. I think that we had a couple of questions about the jobs report and the read-through on that, so I think that answers them.
Well, we'll tweet about it today. I mean, we have a full research team, which many pundits don't have. We have 32 analysts. We have 60 people at the firm. We're going to do real research on this, obviously. But the headline, like I said, if you look at non-farm payroll, miss. Wage growth, miss. You look at the unemployment rate. Now, what that one means is, again, it's mean reverting. It's late cycle. It should bottom at the end of the cycle, which is, again, why you should be fading a late cycle indicator if, in fact, you do macro correctly, which is like a cyclical investor.
Can you throw out your few favorite short ideas?
Kohl's.
You've got a lot of them. I think this question.
I like Kohl's. Kohl's, the Alibaba.
That's a question. Should we buy Baba here?
Should you buy the Baba? I mean, seriously. Just getting that question is just fantastic. I mean, if we had Twitter in 1999, 2000, I would be getting questions, legitimate questions like that said, should we buy the fogdog.com? Should we buy the Corvus? Keith, should we buy it? I mean, this is called momentum levered long chasing of price performance. So again, if you've never seen it before, if you've never called a top before, you think I'm crazy. But guess what? I'm not the one who loses money when these things go the other way. So again, Alibaba has a 280 billion market cap. That is larger than McDonald's. It's as large as Procter & Gamble. You can't even see the numbers. That's why I think that this one's so fascinating, because they can make up the numbers. You can't see the numbers. And some dude in Hong Kong dials in and tells you what his version of the numbers are. And some guy on CNBC actually takes it seriously. I was watching, not to call him out, but Faber, who's I'd say he's a great journalist, certainly on a relative basis, which may not be saying a lot. But this guy, Faber had a hard time actually asking the questions about Baba. I'm going off a little bit on Baba here, but he's like, well, what do you think about the GMV on the monetization mobile platform? And he kept it's like, there's so many metrics in this thing. It's like Alibaba reports non-GAAP margins. Non-GAAP, non-generally accepted accounting principles. We've never seen a bubble this big. So we will legitimately get legitimate questions. People legitimately want to know if they should buy Alibaba at 103. And I say short it. I mean, short Alibaba, short Kohl's. What else did we short yesterday? I mean, short France. I mean, that's easy. Just pick some socialist country that's about to show you a recession. That's pretty easy. What else did we put on there yesterday? You guys could tell me. But maybe we can have some more questions before that, or are we done?
Yeah, we actually have one more. We have a couple more. How much for a lunch at the central banking conference today? This might give a boost.
Well, this is fascinating. So when I was on the buy side, we used to call them the roadshow chicken lunch. And what you'd go over to the Pierre Hotel, and you'd get just a fantastic piece of rubbery chicken. And you'd have one of these characters, these central planners, they'd get out there and they'd tell you their view of the world. This morning, Dudley, by the way, who's one of the most epic central planners, because he was one of the worst economists I ever read research from Goldman, he was saying that this morning that as long as the U.S. forecasts, when according to his plan, they were setting up to do X on interest rates. I mean, just newsflash, Dudley, you've been wrong 73% of the time on your growth forecast, all time, which is a long time. Now, again, this is what people pay for. They'll pay $25,000, $50,000 to have one of these bureaucrats, unelected, by the way. I don't think, last I checked, Bill Dudley was not elected by the people of America. They'll pay tons of money to hear these people tell them where the market's going to go. And it's based on one very simple premise, which is that they can predict and bend and really manipulate economic gravity, which is the most preposterous thing for anyone to think. You'd have to literally be paid hundreds of thousands of dollars to sit there in that seat and eat that chicken and like it. I mean, I think that that's the biggest joke, that we have these guys that are going to be walking around for the next 3 to 6 months getting paid that kind of money to basically make stuff up, because they have no idea. And by the way, when it comes to predicting what's actually going to happen in 3 to 6 months, neither do I.
Great, Keith. Thanks. This is kind of more a serious question. What do you think about, how does Linn look right now, or some of the other MLP names that Kaiser has been hitting on?
So Linn, this is another one, just because we're calling everyone out this morning. Mr. Kramer used to say that we were creating a bear raid on Linn Energy. Just so, short history of it. Linn Energy is a company that, at a bare minimum, looked like they were making up their distributable cash flow numbers. The SEC told them to restate their numbers. Stock got hammered. Then it bounced because everybody and their brother chases yield in MLP land. Cooperman liked it. That's kind of the thing. Kramer slaps it up on his site. This is, bear raid, blah, blah, blah. The truth about Linn Energy is, in fact, that they're 5 times levered debt to EBITDA. They trade at 2 times the multiple of any other upstream E&P stock. And the management team is shady at best, okay? So what happens in a stock like this is it's tied to one big macro expectation that Mr. Cooperman and Mr. Kramer obviously didn't see coming, which is called deflation. Now, when the deflation in the commodity price happens, what you get is the cash flow that the Linn Energy is trying to make up to tell you they can pay their dividend becomes suspect. So again, that's how you play the bouncing ball in deflation. Dollar up. First of all, it's yen down, dollar up, oil down, Linn Energy down. Linn Energy bonds down, down, down. So that's like Linn Energy could literally be a zero. And if you don't think it can, just wait till the day, if we do in fact get $70 oil, what they tell you about what they can do with their dividend.
Pretty straightforward. Thanks everyone. Thanks for tuning in, and we'll see you back here on Monday, same time.
Thanks.